Social Security will make up more than half the income that most retirees expect to live on. Because of this, it is crucial you understand how this benefit works and how you can maximize it so you can have the most comfortable possible retirement. In this video, I'm going to show you how to do just that. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. So how do you maximize your Social Security benefit? Well, you start by understanding the rules. But with hundreds and hundreds of rules of how Social Security works and the different claiming options, it's difficult to do that. So you can either read through all these different rules right here, or you can watch this video where I'm going to lay out for you the most important aspects that you need to know so you can maximize your benefit. So let's start with the fundamentals. Number one, when are you eligible for Social Security? Well, you are eligible anytime between 62 and age 70 for your own benefit, but you have what's called a full retirement age. Your full retirement age is when you are eligible for what's called your primary insurance amount, which I'll explain in a little bit. Depending on your age or your birth year, that's going to determine your full retirement age, and it's going to be somewhere between age 66 and age 67. If you were born in 1954 or earlier, your full retirement age is age 66. So that's the age at which you get what's called your full benefit or your primary insurance amount. If you're born in 1960 or later, your full retirement age is age 67, and if you were born anywhere between 1954 and 1960, add on 2 months to the prior year to tell what your full retirement age is. For example, if you're born in 1955, your full retirement age is 66 and 2 months. If you're born in 1956, it's 66 and 4 months. Keep adding 2 months until you hit 1960 as a birth year or later, and your full retirement age is age 67. Now, you don't have to collect at your full retirement age. As I mentioned, you can collect anytime between age 62 and age 70 with your full retirement age somewhere in the middle. Now, the earlier you collect, you're going to take a reduction in benefits. That reduction is going to be anywhere between 5% and 6.67% per year, depending on how early you collect. Now, it's not actually a yearly drop, it's kind of a prorated amount monthly. So you don't have to wait a full year to get another increase or actually to accept a decrease. It's done on a monthly basis, but that's the annual percentage drop. Now, on top of that, if you wait until after your full retirement age, you get what are called delayed retirement credits. Delayed retirement credits are increases to your Social Security benefit, and it's 8% per year every year you delay after your full retirement age. So if your full retirement age is 67 and you wait until 68 to collect, you get a delayed retirement credit of 8% more. Now, it's not 8% as a cost of living adjustment, it's 8% more plus whatever that year's cost of living adjustment would be, because everyone with a Social Security benefit has the benefit that increases if inflation goes up. Now, here's the thing to note about delayed retirement credits. It goes up by 8% simple interest. So it's not compound, meaning if you delay 2 years, you get a 16% increase. If you delay 3 years, you get a 24% increase. So it's simple interest, but it can still make a profound difference. So that has to do with when you can collect. Now, how is your benefit actually calculated? Well, Social Security looks at your 35 highest years of earnings. And what they do is they adjust those earnings for inflation, and then they take the average of the highest 35 years and use that in computing your primary insurance amount, which again is the amount you're eligible for at your full retirement age. So how does that work in practice? Well, let's assume you started working at 20 and you worked all the way until age 65 without any gaps. Well, that's 45 years of earnings. They're not all going to be used though in the computation of your benefit. Social Security is going to look at all 45 years. They're going to adjust them all for inflation because you were likely earning less 20, 30, 40 years ago than you are today. And then they're going to take that inflation adjusted amount, pick out the 35 highest years, and use that to determine your full retirement age or your primary insurance amount. So as we're looking at this, the planning point is this. It doesn't matter how high your income is. If you don't work full 35 years, you're not going to max out your Social Security benefit. So someone who's making $1 million a year and does so for 25 years and then stops working, their Social Security benefit is not going to be as high as someone who worked for 35 years and made the Social Security limit each year. The Social Security limit is how much you pay taxes on. So for example, for 2023, the first $160,200 that you earn, you pay Social Security taxes on. Anything above that, you're no longer paying Social Security tax, but you're also no longer increasing your benefit. You've capped out for the year. So if you look at this, I'll go back to my example. Even if you worked and you earned $1 million a year, but only did so for 25 years, when you look at your Social Security benefit, they're going to include 10 years of zero income when calculating your benefit. So if your goal is to maximize your income, try to get 35 full years of earnings. Now, you don't need earnings that max out the limit every year, because you also need to know that the first dollars that you pay into Social Security each year are weighted more heavily in the calculation of Social Security. So the first $1,000 that you put in, that's going to contribute more to the formula than the last $1,000 that you put in. It's kind of means tested in that way, where your earlier contributions have a bigger impact on your final benefit than do contributions, say, at the $150,000 mark of income. So that's how it's calculated. Take your highest 35 years of income, adjust them for inflation, that determines your primary insurance amount, and then your primary insurance amount, you can get a reduction in it or an increase in it based upon when you actually collect, any time between 62 and 70. Now let's turn our attention to how is Social Security taxed? Well, the taxation of your Social Security income is based upon something called provisional income. So if you think tax law is complicated, this is just one more layer of complication here, where when you're determining, do I pay Social Security taxes or not, you're either going to have 0% of your benefit included in your income, 50% of it included, or 85% of it included, or some blended amount of the three. What do I mean by that? Well, Social Security says take a look at your provisional income. What is provisional income? Well, it's essentially your adjusted gross income plus any non-taxable interest. So if you have muni bonds, for example, maybe you're not paying federal taxes, or maybe you're not paying state taxes on that, but it is still included in the taxation of your provisional income, or the calculation, I should say, of your provisional income. One interesting thing to note, though, is your Social Security benefit, only half of that is included in your provisional income. But if you add that up, and if you're married and your provisional income is under $32,000, none of your Social Security is taxable. So let's use a super simple example. If you're married and you and a spouse are only living on Social Security, and maybe you're both receiving $2,500 a month, so $30,000 per year each, or $60,000 total, you would take that in half. So $60,000, half of that is $30,000. If you have no other income, that's the only income you're using when it comes to calculating your Social Security benefit. So because that's under $32,000, 0 of that is taxable. Now, if your provisional income is between $32,000 and $44,000, 50% of your Social Security is included in your adjusted gross income. Now, keep in mind, this doesn't mean it's subject to a 50% tax. It means half of the benefit is included in your taxable income. And if your provisional income is above $44,000, then 85% of your Social Security benefit is included in your taxable income. Now, the hard thing about provisional income is it's not indexed for inflation, which means that each year, fewer and fewer people are paying 0% taxes on Social Security, because as incomes go up, including Social Security, as we get cost of living adjustments, more and more frequently people are creeping into the higher provisional income tiers, which means for the most part, if you just want a rough calculation, assume that 85% of your Social Security benefit will be included in your adjusted gross income. So that's at the federal level. On the state level, it depends. Even some states that have very high taxes, so California, for example, where I live, where whether you have interest or capital gain or ordinary income, it's all taxed the same. And those tax rates go up to 12, 13% or so. Well, Social Security is not taxed. So there's 0% income tax on Social Security. But that's for California. Of the 50 states, there are 11 of them that tax Social Security to some extent. Those states are Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Utah, and Vermont. So if you live in one of those states, to some extent, Social Security is going to be taxed. I say to some extent because there are some exclusions for some and some reductions for some, but that may be included in your state taxable income, at least to some extent. Now, what's the planning takeaway from this? Well, the planning takeaway is that for everyone, realize that $1 more in Social Security is more valuable than $1 more in IRA income. Why do I say that? $1 is $1. Well, a dollar is a dollar, but we want to understand the after-tax impact of that dollar. Let's assume you're retired and you live in California, for example, and you're in the 22% marginal federal tax bracket and you're in the 8% California state income tax bracket. So combined, you're in the 30% tax bracket. What that means is if you take one more dollar from your traditional IRA, you will receive 70 cents after taxes. So $1 is truly only worth 70 cents if that's a tax bracket that you're in. Well, now let's compare that to one more dollar in Social Security. Well, we already know, as I mentioned, that California does not tax Social Security benefits. So at 8% tax that's subject on your IRA distribution, we can ignore that for the sake of determining state tax on Social Security. Now, on top of that, you're still in the 22% marginal tax bracket at the federal level, but only 85% of your Social Security benefit is included in that. So if you have one more dollar in Social Security income, only 85 cents is actually subject to that tax. So when you do the math, one more dollar in Social Security income is actually equal to 81 cents after tax. So if I compare IRA, the after-tax benefit, or one more dollar from my IRA, the after-tax benefit of that is 70 cents, versus one more dollar from Social Security, the after-tax benefit of that is 81 cents. So when you're running cash flow models or retirement projections, we have to keep in mind that not all dollars are created equal. This comes into the return calculations we want to assume because some dollars are more tax efficient and it's all about what's the after-tax amount you can live on. So that's how taxes work with Social Security. And now the real planning points come in when it comes to survivor benefits and spousal benefits. Now, just a quick reminder, if you're watching and you're not yet subscribed to this channel, be sure to hit that subscribe button so that you get more videos just like this. So what is a spousal benefit and what is a survivor benefit? Well, to start, everything we've looked at so far is based upon your own earnings record. So when it comes time to when can you collect benefits or how is your benefit determined or even the taxes on that, that's based on your earnings record. So your Social Security retirement benefit is based upon what you've done, your years of service, your years of income, your calculation of your benefit. That's only one component to a well-rounded Social Security strategy. There are also things called spousal benefits, and there are also things called survivor benefits. Let's start with spousal. A spousal benefit says that when you go to apply for Social Security, you are eligible for the greater of your own benefit based upon your own earnings record or 50% of your spouse's benefit based on their earnings record. What does that mean? Well, let's assume that my wife and I are collecting Social Security. Obviously, we're too young for that, but let's just fast forward a few years and assume that's the case. Well, if my wife hasn't earned anything, let's assume she's raising the family and she's doing that, and I have my earnings record, she might look at her benefit statement and say, there's nothing there. Or maybe there's a few years, but I need 40 quarters of service, 40 quarters of income to even be eligible for benefit. So let's just make the assumption that her benefit would say 0, and my benefit, let's assume it would say $3,000 per month. Well, she has a decision to make, and thankfully it's a pretty easy decision here. She says I can either collect 100% of my benefit, which in her case would be 0, or she says I can collect half of what James's benefit would be at James's full retirement age. So if my benefit is $3,000, she is eligible to collect $1,500 per month, even if hypothetically she had 0 income. So that's a really significant planning point for Social Security because when you're looking at what's the most optimal way to collect, it's not just based upon what you have paid in, it's also based upon what your spouse has paid in. Now keep this in mind too. My wife is 3 years younger than I am. So let's assume I turn 67, and that's my full retirement age, and I collect my $3,000 per month. Well, if my wife wanted to collect a spousal benefit at that time, she would take a reduction because she would be 64 at that point. So for her to get the full $1,500, which is the full spousal benefit, not only do I need to be collecting, but she also needs to be full retirement age. So she could collect early at 64, 65, or 66, but she's going to take that reduction. So when it comes to collecting a spousal benefit, understand that 50% of your spouse is the max that you could collect, but it still could be reduced if you collect that early. Now, lastly, with a spousal benefit, let's assume you are married, but now you're divorced. And your question is, do I get a spousal benefit based upon my previous spouse's earnings record? The answer is yes, if you are married for at least 10 years. So if you are married for at least 10 years, even if you're divorced, you are still eligible for a spousal benefit, based upon your ex-spouse's earnings record. Now, they don't even have to know that you're collecting based upon it. You just have to show proof that you were married for 10 years and you're eligible to collect that. On top of spousal benefits, there's also survivor benefits, and this is where you can really protect a surviving spouse when it comes to planning. A survivor's benefit isn't 50% of your spouse's benefit, it's 100% of their benefit if they predecease you. So when you're collecting Social Security, if you have two spouses and one spouse passes away, the surviving spouse is eligible for the greater of their own benefit or 100% of their deceased spouse's benefit. This is why Social Security is really a two-person decision. If you're looking at Social Security and saying, man, I'm not gonna live that long. I don't have long life expectancy in my family. My health isn't that great. I'm just gonna collect early while I can for my benefit. That might not be the best strategy if your surviving spouse doesn't have a high benefit and also has great longevity in their family. It's a two-person decision because it doesn't just impact you, but it also is a great way to protect a surviving spouse. So what I often see make most sense from a planning perspective is, yes, how can you maximize joint income over the course of both of your retirements, but also how do you impact or how do you collect in a way that's going to be most impactful for a surviving spouse if one spouse continues to live much longer than the other. So survivor benefit can be very powerful because you can collect a very high benefit even if you yourself don't have a strong earnings record, if your spouse does, and if they wait to the appropriate time to collect to really max out their benefit. Now, in the same way with spousal benefits, that if you are married for 10 years, you're eligible for a spousal benefit on your divorced spouse. Same thing applies here for survivor benefits. If you are married for 10 years and your ex-spouse is now deceased, you are eligible for a survivor benefit on them. This is where interesting planning points come in, whether you're married or not married, but if a spouse passes away relatively early, you have the option of collecting your own benefit or a survivor benefit, but you have the option of later switching to the other. So if one spouse passes away, say early 60s, the other spouse, they'll maybe collect their own benefit for a while, allowing the survivor benefit to keep growing and then switch to that at a later time, or vice versa. They might collect a survivor benefit early. And by the way, with the survivor benefit, you can actually collect that as early as age 60. All the while, the person who's collecting the survivor benefit is allowing their own to keep growing. It maxes out at age 70, and then they switch over to that. So all kinds of important planning points to be aware of. And when I go back to my initial point, Social Security is a huge foundation of most people's retirement income plans. So if you know the rules, if you know how it works, you can make the most effective steps to make sure that you're maximizing that benefit. Now, one more really important thing here is when we're looking at Social Security and how to maximize it, you should not look at it in a vacuum. Too often people do this analysis without understanding, how does this impact my investment portfolio? How does this impact my taxes? How does this impact my lifetime income I can expect? You can't do that, or you shouldn't do that. If you want to learn more about how does collecting Social Security early or later actually impact the rest of your investment portfolio, be sure to check out this video here where I do that analysis for you. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.